Okay, let's talk about the global economy. The big talking points are how will the Trump tariff trades be implemented? Will it be implemented at all? What is the response now to China's underwhelming stimulus package, which was announced? Who better than to invite Chetan Ahya, Chief Asia Economist in Emerging Markets at Morgan Stanley, to join us on the show. Mr. Ahya, thank you very much for joining in. So first, you tell us, how should we assess this entire tariff situation, which may not play out? How will it play out? By when? Give us your reading of it, and what will it mean for global economies? Because we're talking about potential tariff, a potential trade war, US cuts, maybe some deregulation.
Yeah, so I think from tariffs perspective, what we are currently operating with is an assumption that there may not be 10% tariff, universal tariffs coming in quickly, because that will require legislative changes. So we think in our base case, we should assume that US will probably impose tariffs only on China and take up some bilateral issues with other big trade partners like Europe and Mexico. And as far as China tariffs are concerned, it could be possible that they raise it gradually rather than going at one go. We are assuming that it could be 50 or 60% tariffs cumulatively in terms of whenever the increase is done in total. But it will be taken up most likely in a gradual manner. So with that assumption, we think that the tariffs impact on the region could be much less than what we saw in 2018-19. So to just give you a backdrop, in 2018-19, growth impact was 1 percentage point for the whole region. China also saw 1 percentage point decline in its growth rate. But bulk of that negative impact came from global corporate confidence getting affected, global trade getting affected, rather than the direct effect of tariffs. And therefore, in this cycle, we think the impact could be much less, because now everybody is aware about the issues between US and China. Corporations have already taken up the effort to diversify. So we think that this time the downside could be more manageable than what we saw in 2018-19.
So to summarize, we may not see a uniform 10% tariff on all imports into China, into US, but on China, we will eventually get to 50-60% tariffs, but it will happen in a gradual manner. And the overall impact will be less.
That's right.
Chetan, hi, good morning. So I think markets are just trying to second guess exactly some of the scenarios that you laid out, right? Beyond tariffs, do you think this Trump sweep in the States, will it have any sort of bearing on the direction of interest rate policy as well? Because the Fed's moved. We heard that big statement from the Fed chief as well, saying no one can fire me. But in terms of rate differentials, and the US is going on cutting, Japan has been on pause, though, I mean, intrinsically, I think Japan was on the hiking path. What happens to interest rate differentials and policy, Asia vis-a-vis the US?
So, look, I think, firstly, in the US's case, in the near term, apart from tariff policy, it is going to be difficult for the US to take up fiscal expansion immediately. Our US public policy teams that in terms of sequencing, it could be tariffs first, and then fiscal policy in 2026. So fiscal policy will take time. It will have to get through the approval from the Congress. And also the team has to sit back and work out the math in terms of how much tax cuts they can do and how much revenue or the pay for will come from different parts. So it's really tariffs, which is really at discussion. And that too, as I was mentioning earlier, if it is gradual, then the impact could be moderate. So at this point of time, I think in the next few meetings, the Fed continues to go implementing those rate cuts as we have built in. And so we are expecting, rate cuts to come through in the near term, as Fed was originally building in. So I think that is on track. And as far as Asia is concerned, we are expecting rate cuts to come through. But look, I think when tariffs come, there will potentially be more rate cuts priced in. And so interest rate differentials will still be in a way that Asian currencies will be under pressure if tariffs are taken up as an action.
Hi, Chetan. Good morning and good to see you, Ben. Nigel on this side. I want to come back home to India then. In this sort of a backdrop, what are you pricing in with regard to the RBI in terms of cuts? By when do we get our first cut and how many are you pricing in? And also your quick take on this perceived slowdown here in India. A couple of data points are soft, but the hope is second half of the year will look much better. Capex spending is likely to pick up. The October second half wasn't too bad as well. So what does the RBI do next? And please comment on how do you see things shape up with regard to this softish data?
So first up, we are expecting RBI to take up 2 rate cuts starting in from February. And then depending upon how big a damage to Asia's growth is from that tariffs eventually when they come up, we could see additional actions from RBI. As far as the current growth slowdown that is ongoing in India is concerned, we think that the biggest factor that has caused this growth slowdown is the government spending. When you look at government spending, center plus states taken together, it's 29% of GDP. And so that line item has been sort of relatively stalled. We don't have the state spending data more up to date. But as you saw, the central government spending data up to September, it's been still held back and has not seen that pickup that you usually see after general elections. And so we are expecting that to pick up in the coming months. If you just assume that the budget number will be achieved for capital expenditure, for example, you should see like a 50% increase in government's capital expenditure. Now, I understand that there is skepticism that they may not be able to achieve that target. But even if they don't achieve the target, it will still be somewhere in the range of 30-40% increase in government's capital expenditure in the second half. So we think that this major factor why we have seen that slowdown in India should be coming through in terms of support to recovery in the second half. And as far as consumption is concerned, I think the data that we got from auto companies was promising. And we are also hearing that, independently of that, even FMCG companies are saying that rural consumption is improving. So we think consumer spending should also begin to improve back again in second half. And government capex should lead that capex cycle in addition to that recovery in consumption. So we are still expecting that recovery to come back in second half of financial year.
Got it. So maybe the twin engines will fire up together in H2. That is government spending along with the pickup in consumption. Chetan, great to have that perspective. Thank you very much for joining us on the show today. You have a good day ahead and we look forward to another call soon. Thank you.
Thank you.
All right.